Hello guys, welcome to lesson 14 of the course, and today we're going to talk about market maker trap, false head and shoulders. Alright, so we're going to build upon the market maker trap series from this first module, and on previous lessons we've talked about false trend lines. We've also talked about false breakout out of consolidations, and this is no different from the other ones in the sense that it simply is a prey on retail logic. Okay, it's a prey on retail sentiment. Now, again, as usual, we don't go into the marketplace looking for these things. We don't go into the marketplace looking for every head and shoulders to be a false head and shoulders. Okay, because if head and shoulders never worked, it'll never be in the retail textbooks. Okay, the textbook will never teach head and shoulders. Okay, so there's a reason why sometimes it works, but a lot of times it does not work, because if it does, if all these classic retail patterns actually worked, then you should see a lot more retail making tons of money and being extremely successful in the industry, but you're not. Okay, the statistics actually shows that 9 out of 10 traders are not profitable, meaning they don't turn a profit at the end of the month, and it's based off of, number one, their market psychology and their understanding of price, and also then number two, their actual price action knowledge, because they learn falsities in price, and this is one of them: head and shoulders. Now let's discuss what a classic head and shoulder looks like. Alright, so a classic head and shoulder looks like this. Okay, so it is a reversal pattern. That's what an head and shoulders is. So we have a classic head and shoulders. So when market is going on a uptrend and you're anticipating a reversal in price will go like this and trade lower. Now they call this the neckline. Okay, and then they call this the, so let me use actually alright, so this is the shoulder. Okay, this is the head. And I'll teach you how retail trades with the concept. Okay, so this is the head of the pattern, and it's a little bit too large, so let me just reduce that a little bit. And then this is the right shoulder, and we have the left shoulder, classic retail pattern. And then we have the neckline. Okay, so we're using the lower swing low prior to the right shoulder forming as neckline. If this was lower, I would use this as neckline. A lot of times they'll be almost relatively around the same price range. Okay, so we have that as the neckline, and this is a classic head and shoulder pattern from the retail textbook. So when a reversal is anticipated and this type of pattern presents in the marketplace, retail oftentimes will short. That's what they teach in the textbook. They don't teach them to short the right shoulder. They teach them to short the breakout of the neckline or the retest to the neckline. So this is what the textbook teaches. Either short on a sell stop the breakout, and your target is going to be a measurement of the head to the neckline, and then you project that on the downside. So this is what I mean by the measurement. So what retail does is they'll measure the range from the head or the shoulder, and then they'll project that on the neckline. So if price breaks below the neckline, they are triggered on a sell stop to go short, and their trade will look like this. Okay, and their target is going to be down there, and their stop a lot of times is just going to be at the right shoulder of the head and shoulders, and that's the trade you're looking for. And you're looking for a measured move from the head to the neckline or the right shoulder to the neckline, and they'll measure from the neckline and project it on the downside, and that's your target objective. So that's what the textbook teaches. Okay, that's what all the courses teaches. I've been on multiple courses over the last 5 to 6 years, and this is what they all talk about. Okay, in terms of teaching how price delivers. All right, so now if they're not short in the breakout of the neckline, they'll short the retest back up into that neckline. They shorten the retest, and the market expands lower. So that's what the textbook teaches. And again, remember, head and shoulders pattern is simply a reversal pattern. Okay, so retail will use that as a changing trend. That's what retail thinks. It is a changing trend, and they're shorting and downwards. And then we also have an inverted head and shoulders, and that's the opposite for a changing trend from a bearish trend to a bullish trend from retail perspective. So we're going to clear up all of this, and we're going to define inverted head and shoulders, because that's also important to our market maker trap series today, or market maker trap lesson today. Okay, so like the classic head and shoulders, price is on a downtrend. All right, lower lows, lower highs, makes a lower low, makes a slightly higher high, and then starts the expansion. And this is the neckline here. Left shoulder, head, right shoulder, it's inverted. Okay, retail will go long at the retest to the neckline, or at the breakout of the neckline, retail goes long and their stop goes below here, and then they use a range protection, which is from the head to the neckline or the shoulder to the neckline. They'll project the range, and they will use that as a target objective. So if they're buying the retest neckline, then their target is going to be a measurement of the impulse leg. So this is the impulse leg, and then they'll measure it from the neckline, anticipating the market to run higher. And just stop a lot of times going to go below the right shoulder. Okay, that's where retail stop classically goes below. Sometimes they could have stops below the head, but typically it is below the right shoulder. Okay, so that's the classic retail head and shoulders pattern. So we have the classic head and shoulders pattern when price is reversing from an uptrend to a downtrend, and then we have the inverted head and shoulders pattern when price is reversing from a downtrend to an uptrend. And I've described the way in which retail will engage in these type of patterns in price and use that to frame an execution. Now we discard all of that, because now we're going to rewire the concept of head and shoulders into an institutional perspective. All right, so now first off, when we are viewing price, we don't go into the market looking for market maker traps. We don't go into the market looking for consolidations, looking for false breakouts or double bottoms and double tops, because if you go into the market looking for price and trying to view patterns, then you're no different from retail, because that's the mistake retail does in terms of their analysis. They go into price looking for patterns. They want to see patterns, and patterns are oftentimes a trap. They're a trap if you don't understand the context behind the pattern, and that's been a running theme on the course from lesson 1, and I've been trying to drum into your head that you're not supposed to view the market from a pattern perspective, even when you're using all these concepts like fair valuation and reservoir balance and order blocks. You don't view price from a pattern perspective, because if you do, then you're not going to know the context in which they're more likely to fill. I know the context in which a trade is more likely to fill versus when it is not likely to fill. You don't, okay, because you're not familiar with the inner workings of why certain concepts fill and why they should hold in price. Okay, so as usual, you build your analysis from the daily time frame, higher time frame understanding. You identify order flow, and then you identify general liquidity. And then once you've done that, you refine that to a lower time frame, and then you identify lower time frame general liquidity. Now, if you spot any of these market maker traps in your understanding of price, then that's a confirmation of your narrative. Okay, now remember what you're doing in price by reading where the general liquidity is and reading where what discount or primary price should be expanded from. Okay, what you're doing there is you're creating a story, you're creating a narrative. As you're creating a story and you're creating a narrative, okay, that story or narrative needs to have a plot. Okay, and the plot is all these subtle things like the market maker traps and the SMT divergence, which I talked on the last lesson. Okay, these are all plots that comes together to create a cohesive story. That's what we have here. So I'm going to use a live price action example of something I called. Okay, we looked further by here. So go back on the commentary on on Wednesday evening, so 29th of March 2023. Go and watch the evening commentary where we called this higher. And don't mind the notification I just got from YouTube. I'm sorry about that. I'm gonna find a way to shut it off. So now let's look at this. Okay, first off, let's define where our general liquidity is. Okay, so we're gonna go out to a daily time frame and alright, so we're using the same example on euro. We're calling up here as the general target general liquidity. On euro dollar, we have a daily fair value gap there, and we also have a rejection block up there from that weekly mitigation block. So let's go out to a weekly time frame. Let's define that weekly mitigation block, and this is the mean threshold there. Okay, and we're gonna split this in half, and we're gonna go down to a lower time frame, and you can see where that displacement from this breaker block after a run on sell stop at an higher time frame discount. Remember, that indicates a longer term shift in order flow, so we're looking for buy sell liquidity. Alright, so on the daily, what higher time frame? We already know what general liquidity is. General liquidity is here, but before we get up there, we have a near term general liquidity, which is the short term daily high. So that's a near term general liquidity. Okay, and then we have, after price trades up into that buy sell liquidity pool, then we have another one at 1.09877 or 1.0990. Okay, now we have an old imbalance, which is a sell side imbalance by an efficiency, and because we're inside that range, it becomes an inversion level. So I've talked on inversion levels. That becomes an inversion level whereby it's no longer a premium array, it's now a discount. Now we have a old imbalance plus a bullish order block. This candle is closed above this bullish order block, so that is a bullish order block. This is actually a propulsion block, but I'm going to talk more on propulsion block on the next lesson, so I don't want to rush the process. So this is a bullish order block down there. Take note of the open of that bullish order block. So we're inside an old imbalance plus a bullish order block. So now if we worked our way down to a lower time frame, now you can see narratively we had to run a sell stop. So we have clearance here, price runs below those clearances there. We can see displacement, and we can see price trade back down here. This is institutional sponsorship. Remember, when we see displacement from an high time from discount, what's the high time from discount, Jane? That's this breaker block. Oh, I just sneezed. I'm sorry. Okay, so that's a breaker block here. That's the high time from discount. Okay, coupled with a bullish order block. So when we see displacement away from there, and then price returns back down into a discount, that right there, that's a very strong confirmation of institutional sponsorship. And then look at what happens next. You can see order flow ensues. Okay, new order flow ensues, which is buy side. So we are very clearly bullish in price. Okay, now this is that daily bullish order block, and you can see here we look like we're in the process of forming a right shoulder on a head and shoulders pattern. Okay, so we have the left shoulder here, we have the head here, and then we have the right shoulder here. Now remember, which is Rito going to use to go to frame a setup? You're gonna look to short the break of the neckline, okay, and you're gonna place your stops on the right shoulder and the head of the pattern. Now, because our bias is bullish and our drawn liquidity is up here, we already know that this is going to be a market maker trap and not a reversal. But retail does not know this, because retail does not have the understanding we have in price. So they're viewing this as a reversal and price is going to run sell side. Meanwhile, we already know that price is going up here, so we know it's all a trap. So we're going to start with London session. And let's watch what price does next. So we have left shoulder, we have head, we have the right shoulder, and look at what price does. Price runs below the neckline. Okay, runs below short-term low, runs below the neckline. So we have left shoulder, head, right shoulder, and the neckline of the right shoulder. That's where price runs below on the sweep. Okay, so if we use here, it gets very close to the body of this left neckline. Okay, but if we use the right neckline, you can see here, or the body, we have a sweep down there. So now what's going on there is retail is shorting the breakout of the short-term low, and then this short-term low, they're selling on a stop. If they're selling on a stop and we are bullish, remember this block line here, that's a daily bullish order block open. Okay, so we expect to see, remember, institutional sponsorship. So when I say displacement away from there to validate institutional sponsorship, so let's see. Liquidity on the neckline taken out. And finally, we run liquidity on the buy side. Okay, again, all of this was just a play, a narrative. That's all it was, because retail, they're falling for the trap. They're selling short the breakout of the neckline. Okay, meanwhile, price at a daily discount. All right, so as it runs lower, what you're looking for is immediate displacement. Okay, and it comes in at an active session, London session. All right, so price runs lower, displaces a little bit. We have bullish order block here. That's a buy, and that will be trade for you to buy. Where's your sub going to be? Your sub is going to be below the low that was just swept. Okay, and your target is going to be the high here, not just the neckline. Why? Because we know the drawn liquidity is up here. Okay, so we're looking for a short-term buy side liquidity pool in direction of that daily drawn liquidity. We don't need to hold all the way up here. We can leave a portion over. We can take partials and allow for price to reach up there, but we always want to pay ourselves. So just price running up here, that's enough. That's enough for us to secure some partials, 70%, 80%, and then you can leave the rest around for this. So even if it gets up there or not, you don't care, and your sub goes to break even. So even if it gets up to that final target or not, you don't care because you've taken off partials. And this is how you reverse engineer the retail patterns. Now, if you were bearish and our bias was bearish, then we're not gonna view this head and shoulders as a false head and shoulders. Okay, like here for example, so we have the head and shoulders here. You can see left shoulder, head, right shoulder. This is the neckline, and you can see that break. It actually works here, and that's why I teach you guys that it works sometimes, but you have to know the right context, which retail does not. Retail doesn't know the context in which these patterns are going to work versus not, and how can we define when they're supposed to work or not? By defining where the drawn liquidity is. Okay, once we can define where drawn liquidity is, then we know if they're valid or not. We can define the validity of a retail pattern but understanding when your own liquidity is. So hopefully this was an insightful lesson, and I'll talk to you guys on the final lesson of this module, Trade Safe.